Are you holding DBS, Singtel, or SGX in your portfolio? Well, what if I told you one of them could be slightly overvalued, and another may be a hidden dividend gem hiding in plain sight? Stay with me till the end, because I'll break down the truth behind these blue-chip giants, show you who's still a smart buy, and who may be past their prime. Like this video, smash that subscribe button, and turn on the bell so you never miss out on smart investing tips from Wealth for You. And just a quick reminder, this video is for education and entertainment purposes only. It is not financial advice. Please do your own research or speak to a licensed financial advisor before making any investment decisions. Part 1. What is the Singapore Exchange, or SGX? Let's start with the basics. The Singapore Exchange, or SGX, is like our financial heart. It's where companies get listed and where investors like you and me can buy and sell shares. Think of SGX as the Sheng Xiang for investors. Instead of groceries, you're shopping for stocks, REITs, ETFs, and even bonds. But SGX isn't just about Singapore companies. It also offers access to derivatives, foreign stocks, commodities, and fixed income products. So whether you're a young investor just starting out or a retiree looking for dividend income, SGX has something for everyone. It's also where many of Singapore's biggest blue-chip companies, like DBS, Singtel, and SGX itself, are listed and traded daily. Behind the scenes, SGX provides the infrastructure that ensures trades are secure, settled properly, and regulated, so you can invest with peace of mind. In short, SGX is the engine room of our financial system, and it's where your investing journey begins. Part 2. The business of SGX, Singtel, and DBS. Now, let's zoom into the main characters of today's video. 3 familiar faces on the SGX. 1. SGX Singapore Exchange. SGX is not just a stock supermarket, it's the cash register, the security guard, and even the information counter. Here's how SGX makes money: trading fees. Every time you buy or sell a stock, SGX earns a small fee. It also earns from more advanced products like futures and options, and fixed income trading. After trades are made, SGX ensures they're safely processed, like a clearinghouse. Institutions pay for access to real-time financial data and trading insights too. In short, SGX earns more when market activity is high. It's a stable business, like collecting toll fees on an expressway. 2. Singtel, Singapore Telecommunications Limited. Singtel is more than just your mobile line and fiber broadband. Yes, it's Singapore's largest telco, but it also owns regional stakes in Bharti Airtel in India, Optus in Australia, and Telkomsel in Indonesia. Singtel is shifting its focus from being just a telco to becoming a digital infrastructure and tech company. It's investing in AI and cloud services, cybersecurity and IT services via NCS, and also data centers, satellites, and 5G networks. So while you may see Singtel as a boring utility stock, under the hood, they're reinventing themselves for future growth. 3. DBS Group Holdings. DBS is Singapore's biggest bank, but it's also a tech company in disguise. They offer everything from regular banking, your POSB savings account and PayLah, to loans for homes, cars, and businesses, wealth management services for high-net-worth clients, and corporate financing and trade solutions for regional businesses. DBS has been expanding into countries like India, Indonesia, Taiwan, and even Australia, while leading the charge in digital banking innovation. It was one of the first banks globally to build a mobile-first banking experience and invest heavily in AI-driven solutions. Plus, DBS continues to grow its fee-based income from wealth management and investment products, not just relying on interest from loans. Together, these 3 companies represent stability, transformation, and regional growth potential in very different ways. Part 3. Latest financial results for fiscal year 2025. Let's now dive into how our 3 stars, SGX, Singtel, and DBS, are doing in 2025. First up, SGX. Singapore Exchange reported a net profit of 235 million Singapore dollars for the first half of fiscal year 2025, a modest but healthy 2.2% increase. Total revenue came in at 592 million Singapore dollars, thanks to a boost from foreign exchange and fixed income trading. What's especially reassuring is that 82% of SGX's revenue is recurring, like subscription fees and clearing charges. That means it's stable, predictable, and not entirely dependent on market mood swings. Think of SGX like an MRT operator. Whether it's rush hour or off-peak, it's still collecting ticket fares. Next, let's look at Singtel. Singtel posted a strong rebound this year. For fiscal year 2024, net profit came in at 2.14 billion Singapore dollars, boosted by better results from its regional associates like Bharti Airtel and higher earnings from Optus in Australia. Even better, free cash flow jumped 45% to 3.2 billion Singapore dollars. That's a strong cash engine. But what's really interesting is Singtel's new direction. It's pivoting towards technology and AI, investing in data centers, cloud services, and even AI platforms under REAI. Instead of just being your telco uncle, Singtel wants to become a full-fledged digital infrastructure boss. And finally, DBS. DBS continues to impress. It reported a trailing 12-month net income of 11.15 billion Singapore dollars, with revenue reaching 21.83 billion Singapore dollars. Margins are healthy, and returns remain strong, thanks to interest income and growing contributions from wealth management, regional lending, and digital initiatives. Whether it's pay law or private banking, DBS is firing on all cylinders. In short, all three companies remain profitable, but they're at very different stages of their business journey. Part 4. Valuation Snapshot. Are these stocks cheap or expensive now? All right, time to answer the big question many investors have. Are these stocks worth buying now? Let's break it down with some simple valuation checks. Now, looking at SGX, the Singapore Exchange, at the time of recording, SGX has a market cap of about 9.94 billion Singapore dollars. Its price-to-earnings ratio is around 20.4 times, and its price-to-book ratio sits high at 6.1 times. What does that mean? Basically, SGX is not cheap. You're paying a premium, not because it's a fast-growing tech unicorn, but because it offers consistency and dependable cash flow. Think of SGX like buying a good condo in Bishan. Not cheap, but you know it's stable and holds value well. So, my verdict? SGX is fairly valued, maybe even slightly expensive. But if you want stability and steady dividends, it might still deserve a spot in your long-term portfolio. Moving on to Singtel, Singapore Telecommunications. Singtel's current market cap is about 41 billion Singapore dollars. Its PE ratio is roughly 19 times, and its price-to-book is around 1.6 times. That puts it somewhere in the middle. Not overly expensive, not dirt cheap either. Here's the twist. Singtel is undergoing a major transformation. It's investing in AI, digital services, and infrastructure. If these plans work out, there could be room for upside. But if they stumble, the price might stay range-bound. So, verdict. Singtel is reasonably valued. If you believe in its long-term pivot to tech, this could be a good long-term hold. Now, DBS Group Holdings. Here's where it gets interesting. DBS has a market cap of 124.81 billion Singapore dollars, a PE ratio of just 11.2 times, and a price-to-book ratio of 1.83 times. Compared to its own history and other global banks, this is undervalued. Plus, it has a strong dividend yield above 6% and continues to show strong profit growth from both traditional banking and wealth management. Think of DBS as a BTO flat in a mature estate. Solid, reliable, and possibly still underpriced given its quality. Verdict. DBS looks undervalued at current prices and offers both dividend income and capital upside. Part 5. Dividend history and yield. Can these stocks give you steady income? Now let's talk about one of the main reasons many Singaporeans love these three stocks: dividends. After all, who doesn't like receiving ong bao from your stock portfolio every few months? Let's look at how SGX, Singtel, and DBS have performed when it comes to rewarding shareholders. First up, SGX, the steady payer. SGX is like that friend who never forgets your birthday. they've been paying dividends consistently for years. While the current dividend yield is about 2.6%, it's backed by strong free cash flow and recurring earnings. It may not be the most generous dividend out there, but it's very reliable, ideal for investors who like predictability over flashiness. Verdict: SGX is a solid pick if you're looking for low volatility income, even though the yield is on the lower side. Next, Singtel, dividend with a bonus. Singtel's FY 2024 dividend was 14.9 cents per share, and they threw in a special dividend of 3.8 cents on top, like getting extra fries with your meal. That brings the total yield to around 5.5%, which is actually quite attractive for a large-cap telco going through transformation. And the best part? Singtel has paid dividends consistently for over 20 years, even during challenging periods like the pandemic. Verdict: good yield and a track record to back it up. You're not just getting data, you're getting dividends. And finally, DBS, king of dividends right now. DBS is having a strong payout year. Up to June 2025 to date, they've already declared $1.35 per share, and the forward dividend yield is about 6.78%, one of the highest among Singapore blue chips. And it's not just a one-off. DBS has steadily raised dividends over time as earnings grew. Plus, they've also rewarded shareholders with special dividends, bonus shares, and share buybacks in recent years. Verdict: if you love income, DBS is currently a dividend powerhouse. Strong cash flow, high yield, and consistent payouts. In short, SGX equals stable but lower yield. Singtel equals attractive yield plus bonus. DBS equals dividend king right now. If your goal is to become cash flow rich, not just paper rich, these dividend payers could form the foundation of a resilient income-generating portfolio. Part 6. Should you buy, hold, or pass? All right, now comes the million-dollar question. Should we buy, hold, or just say next to SGX, Singtel, and DBS? Let's break it down. SGX, the reliable tortoise. SGX is like your reliable NTUC ante, not flashy, but dependable. It runs the Singapore stock market and benefits from market activity, derivatives, and data subscriptions. Business is stable, and recurring revenue makes up over 80%. But don't expect this tortoise to sprint. Growth is steady, not spectacular. Verdict: good for conservative investors looking for stability and regular dividends. A hold for long-term income seekers. Singtel, the reformer with potential. Singtel is in the middle of a makeover. After years of being weighed down by legacy telco challenges, it's now investing heavily in AI, digital services, and infrastructure. Free cash flow is up. Optus is recovering, and regional stakes like Bharti Airtel are pulling their weight again. It's like the uncle who used to sell pagers, now running a startup. Verdict: if you believe in the digital pivot and want to accumulate while it's still reasonably priced, this could be your chance. A buy slowly stock, not for excitement, but for steady comeback potential. DBS, the dividend beast. Now DBS, this one is in top form. Strong earnings, massive cash flow, high dividend yield, and still undervalued compared to global peers. Their digital banking game is strong, and they're expanding in wealth management and regional lending. DBS is what happens when a lion becomes a cash cow. Verdict: most attractive right now. For long-term investors, this one deserves a firm hold, or even buy more on dips. You're being rewarded with growth and fat dividends. Final thoughts. If your goal is to be cash flow rich, not just look rich on paper, then SGX, Singtel, and DBS might just be your best friends. These aren't the flashiest stocks. They won't suddenly double in price and make headlines, but they quietly do something more powerful. They pay you cold, hard cash, quarter after quarter. While others are chasing hype, you could be collecting passive income that lets you sleep better, breathe easier, and maybe even upgrade from Kopi O to Kopi C Sudai. Being rich is not about bragging rights or watching your net worth go up and down like a roller coaster. It's about building a portfolio that sends money back into your bank account every quarter, not one where your wealth is locked up and you can't even touch it. Because let's be real, What's the use of a $1 million portfolio if you're still budgeting for kopi at the kopitiam? That's not freedom. That's just looking rich on paper. So ask yourself, are you building a portfolio that looks good in theory, or one that actually pays you to own it? Are SGX, Singtel, or DBS already in your portfolio? Planning to buy more? Let us know in the comments below. And hey, if this video gave you value, please like, subscribe to Wealth for You, and share it with a friend. Help more Singaporeans build portfolios that pay them while they sleep. Your wealth journey is yours to design. Let's make it cash flow rich.